Hello, everybody, and welcome to 8th Season Capital. My name is Thabo Ngalo. I am a managing partner and advisor at the firm. And what we provide are specialist investment services, both advisory and on the management side of the investment world as well. And we focus on both traditional and alternative asset classes. And we offer traditional asset classes, primarily mutual funds, retirement funds, in partnership with Allen Gray, which is one of the largest investment managers based in South Africa, with a presence overseas through the Obis funds and the other international businesses. And on the alternative side, we offer that primarily through venture capital, offering access to venture capital funds and to other funds that investors traditionally don't get to access, such as private credit, and I mentioned venture capital, and a few others, a few other strategies that are generally harder for investors to access. So today we thought we'd unpack a little bit about what traditional investments are and how they differ from alternative assets. If you look across the world, even if you look across your own portfolio, a lot of people are exposed to traditional assets. And I think that's why they're called traditional assets, because that's where a lot of people have historically had a lot of their investments. And a lot of people typically understand traditional assets much better than the alternative space, which can get quite complex. And at times, because of its private nature, alternative assets remain largely, inaccessible to investors traditionally. Especially the man on the street, you and I, who invest primarily through their pension funds, and under their pension funds would typically be exposed to, your normal what I'm going to jump into today, which is your traditional assets, versus what you also find. People not necessarily being exposed to alternative assets. So let's jump into it and unpack a little bit about what traditional assets are and how they can help in your investment portfolio. So traditional assets are generally divided up into, call it three main, or I'm going to call it four. One which is equities, or what in our part of the world in South Africa we call shares. What you also find are fixed income securities. So these are your bonds, and I'll jump into a little bit of what they are. And then you also have your cash holdings, which are generally a lot of people would have those in different forms. Either it could be a bank deposit, it could be other specialized unit trusts or mutual funds that you can find. And what I also like to do is add real estate or property, because for a lot of people, property or their home represents a very large chunk of their investment portfolio. And I want to lump it all up, although it can get quite complex. And in some literature, you might find real estate or property being classified as alternative. But in this discussion, I'm going to lump it on, particularly referring to your primary asset or your primary home, which tends to be a primary asset for a lot of folks out there in terms of how they're exposed on the investment side. So jumping into it, what are equities? So let's jump right into it. So equities are essentially shares in companies. And it's largely shares in very large companies that are listed on a stock exchange, companies that most of us would know and interact with on a daily basis. Typically large, as I say, typically companies already have a very large market share, large customer base, and as I mentioned, also typically listed. So you do find two types of equities, essentially, or two major types. One you'd want to call ordinary shares, which are your normal investments in a company where you buy a share in the business, and you typically buy it with the aim of getting dividends or getting growth or getting some sort of value out of these assets. And then what you also find are what I also call preference or preferred stock. And what these are, they are very similar to obviously ordinary shares. The biggest difference being that pref shares also give you some preferential rights. You might rank a little bit higher in terms of when cash flows come out of a business, when a business, a listed company pays dividends, you might find that you rank a little bit higher. So you might be first in line to get dividends, you might be first in line to get special voting rights and so forth. So those two represent your two classes essentially of or your two main classes. It can get obviously a little bit complex in terms of how some shares are structured, but by and large, your ordinary shares and your pref shares are really what's available out there to the man on the street or to the individual who's investing in listed companies on various stock exchanges. Either in the JSE, which is our local stock exchange here in South Africa or across the world. So equities, I think, are pretty straightforward, and a lot of people tend to understand how to buy a share, how to get on a platform to own various shares. And also, they make it, unit trust or mutual funds have made it a lot easier for individuals to invest in equities without having, the deep knowledge of which company to choose, when do I buy, when do I sell, and so forth. So equities, typically well understood across the world, typically well understood by a lot of investors, and form a very large chunk of a lot of people's investment portfolios. And then you find fixed income securities. Now, fixed income securities could involve bonds, include bonds, they include corporate bonds, they include municipal bonds, and various others that are a lot more specialized without going into the deep detail. But typically, a lot of people access fixed income through government bonds. And a lot of these features that sit inside what you call a balance fund. And what a balance fund does is essentially spread its money across both equities, bonds as fixed income, and cash, and maybe a little bit of property as well. So bonds have a characteristic, obviously, of you put your money in, and they kind of help you get a steady income from the investment. So of course, a bond would have a percentage that pays you out every month, every year, etc. And the various forms of bonds that are out there also have different features. As I say, you can find largely government bonds, which always traditionally been seen to be risk-free, although that's not always the case given what we all know about the world at the moment. But they are typically classified as risk-free investments that investors can access, park their money, and get a steady income coming out of it. You also get corporate bonds issued by large companies. Typically, what you'd also find, listed companies on the stock exchange would also issue a bond, very similar to what you'd find on the government side, with a fixed income coming through at a certain percentage. However, they tend to be a little bit more risky because now you're investing in a corporate versus a government, which, as I mentioned, has traditionally been thought of to be risk-free. What you also find, if you go a little bit lower on the government side, are what we call municipal bonds. And what municipal bonds are essentially issued by either a local municipality or the likes, I guess, and they tend to be a little bit riskier than your bigger government bonds because they might be backed by only a small municipality that might not necessarily generate as much cash and might not necessarily be able to print money, as opposed to what a government would be able to do on a fixed income note, government note. So you typically find this, and what you also find are what they call CDs, certificates of deposits, and these are typically issued by a bank or by a large financial institution with the aim of also having the same characteristic of giving you a steady income that comes from that bond or from that security. The third one is your cash and cash equivalents. And these are typically very well understood. It's the money in the bank, essentially. And they come in different forms as well. So it could be a fixed deposit that you have in a bank. It could be a money market fund. that you might invest in through a unit trust portfolio or through a similar kind of mutual fund that you find all over the world. And then you also find T-bills that typically form part of a money market or a cash investment. Now, if you look at the risk essentially of the three big classes I just mentioned, you obviously would know that your cash investment could be your safest. Not always. I mean, you also have to consider things like inflation, but it's typically, there's a lot less risk exposure when you're holding cash, because cash doesn't fluctuate like shares, for instance. And as you go up a little bit on the risk chain, you find fixed income, which might have some defaults, as I mentioned, especially around corporate bonds, around municipal bonds that might expose investors to some defaults. And of course, at the high end, you find equities, where there's a lot of fluctuation. We're all aware of what's happening in the stock market, especially what's been happening of late. And I think that's where the risk brackets, or at least if you want to look at the risk, that's kind of where you are on that chain. The fourth one I like to include, although some people might also include it as an alternative asset, depending on how you invest in this asset class, is property. So property would be, I think that's well understood, it's either your house, or investing in office space or office buildings, or retail businesses, retail property businesses, apologies. And those typically would be a little bit more risky. You'd be aware that your home, the value of your home can fluctuate for various reasons. If your suburb or your town or wherever you live deteriorates, you might lose money from your property. So it's a little bit risky, but not as risky, I guess, as the equity equities or equity asset class. And what you also find is, if you further go down that property chain, you'll find a lot more risk. For instance, if you invest in office space, if you're an investor in office space in 2020, when the COVID pandemic hit, we all know what happened with offices. A lot of offices were closed. People started working from home and so forth, and they present a lot more risk than I guess your traditional home. And what you also find are retail property assets. So this could be your malls, your outlet parks out there, and those are a little bit riskier as well, because, as you know, you are then exposed to the consumer chain, or what's happening with the consumer in the economy. So those four asset classes are really what you'd want to call your traditional assets. And they tend to form the bedrock of a lot of investors' portfolios. So if you look at a lot of people's assets or investment portfolios, you find much larger exposure to these asset classes. If you look at your pension fund, for instance, at work, or your retirement funds, they tend to have a much larger exposure to these four primary asset classes, and everyone tends to understand them quite well in terms of how they work. Understanding them is fairly simple for a lot of people. Now, there are many ways you can access traditional assets. From what a lot of people put their exposure on, could be around things such as mutual funds, unit trusts, as we call them in South Africa. Now, what they tend to help is you invest in one fund that gives you exposure to a range of these asset classes. So, for instance, if you invest in what they call a balanced fund, what a balanced fund does is it gives you exposure in a balanced way, as it were. So the manager of a balanced fund would take views on how much they'd want to invest in equities, how much they want to invest in fixed income, and how much they want to keep in cash. And they might also have a few other exposures, such as property, as I mentioned, out of the four. So they're a lot more easier to access. You also have a lot of specialist funds that allow you to access equities, and there's a whole range of equity funds out there. You could find a growth fund, a value fund, different styles, absolute return funds. And in later videos, I'll get into a bit more detail as to what all of these different mutual funds and investment strategies are all about. Or you could invest in a pure fixed income fund, that buys government bonds, municipal bonds, and so forth. And there, you are getting a steady income managed by a professional manager. That's a lot safer than, I guess, you putting money in some of these bonds yourself directly. And of course, they also give you exposure to cash. You find a lot of balanced funds tend to have a holding on cash, and they will take a view on duration. They will take a view on what they think yields are like on say the fixed income side, on the cash side, and they will choose and weight the portfolio, the balanced fund to meet their views naturally. So traditional funds, nutshell, what you tend to understand, mainly for 3 or 4 asset classes: equities, fixed income, cash, and property are what we all understand, and they tend to have a lot less risk. And I'll jump into alternative assets on the next video to just give you a bit of color as to what what alternative assets are and why they are seen to be a lot riskier than your traditional asset classes or the 4 traditional assets out there. The other advantage you have is of course that you have a lot more liquidity, meaning when you're invested in primarily the 3 main traditional assets, equities, fixed income, and cash. When you need your money, you tend to be able to get it a lot quicker, and that's not a feature you find on the alternative asset space, where you find a lot more private assets, a lot more illiquid assets that you're not necessarily going to be able to access when you need to. Other good thing, I guess, about investing in traditional assets is it allows you to diversify your portfolio. So you are able to invest in an equity fund, as it were, or invest directly in equities if you understand how to maybe trade through a stock portfolio or a share portfolio with the likes of easy equities. A lot of range of there's a huge range of stock trading accounts that are out there available for people to access equities. So primarily, that's what traditional assets are. How you access them, you can get in touch with us, and we're able to connect you to, as I mentioned, through our Allen Gray, our partnership with Allen Gray, and through our Allen Gray platform, you are able to access various funds, various investment opportunities, both local and international. And they also allow you, for instance, to invest in a unit trust or a mutual fund domiciled in let's say Europe or the US, and that helps give you exposure to companies that you wouldn't necessarily, or investment classes, investment types that you wouldn't necessarily be able to access if you were investing by yourself without the use of a manager. So in a nutshell, that's what they are. Do get in touch with us if you think there's a way we can help you restructure your portfolio, or even start your portfolio from zero, and give you exposure and give you great advice on which managers to choose, looking at their track record, looking at the kind of returns they've given in the past. Although it's always important to say that past performance is not an indication of future performance, but it does help to understand where a manager has been, to get a good idea of where they could take the portfolio to. So most certainly get in touch with us if you are looking at your investment portfolio. You want to understand better what unit trusts are, what kind of unit trust you want to access, equities, fixed income, cash, and also property. And we are more than happy to help you access those all those traditional assets through our advisory work and through our partner funds and partner fund managers as well. Thank you.